All right, we're back in Liberate, Your Journey to Lasting Financial Independence, Chapter 5. And we're picking up here Part 2 with health insurance to start us off. All right, so you want to have adequate health insurance, at least major medical. Hopefully your employer's plan is sufficient. Never go without health insurance. If you never have significant medical problems or do not become disabled throughout your life, consider yourself blessed. Your insurance premiums were well worth a happy and healthy life. If you are unfortunate enough to have health problems, my heart does go out to you. The insurance coverage will not remove the pain or compensate for the inconvenience. Still, it will help dampen the financial burden major medical problems and disabilities cause. Neglecting to acquire health insurance could ruin your entire FI. Without adequate health insurance, if a health problem occurs, the bills could be enormous. Meet with your health insurance agent immediately to ensure that you have proper coverage. Disability insurance. Your ability to earn income through work is most likely your most precious asset right now. Therefore, I recommend you protect your ability to earn income with disability insurance. Proper disability insurance should be a long-term, standalone policy, which means you will not purchase it through your employer, but through your insurance agent. Make sure it's an own occupation policy so that it provides benefits if you are unable to perform the duties of your specific occupation, even if you can work in another capacity. For example, if you are a surgeon and can no longer perform surgery due to a disability, you would still receive benefits, even if you could work in another job outside of performing surgeries. For instance, maybe teaching how to perform surgeries or something like that. It is essential to understand that disability benefits never cover 100% of your previous earnings. However, it generally covers 50 to 70% of your pre-disability income. While this disparity might be disappointing, remember that it is better to have a portion of your income than no income at all. Also, make sure the disability benefits continue to pay out until normal retirement age, which is typically age 65. Remember, even if you receive disability payments, you will still need to save and invest to reach FI because you cannot rely on disability income after you reach age 65. Get disability insurance to protect the most important asset you have now, your personal income engine. And more about this concept later. All right, on to life insurance. If you are single, have no obligations after your death, and don't want to bequest money to anyone, then you probably can go without life insurance. If you are married and or have kids, you will want to make sure that you have adequate life insurance in case you die too soon. There are various reasons to purchase life insurance. However, the only reason I'll be explaining is to make sure your FI is fully funded upon your death. In this case, you will want enough life insurance to fill your FI gap, the difference between your minimum FI goal and the amount in your FI account. Your FI account is your dedicated investment account that fuels your financial independence. And we'll learn more about that in upcoming chapters. For example, if your minimum FI goal is $2 million and you have, right, we're trying to start with the end in mind, right, with the destination where we're trying to go. If your minimum FI goal is $2 million and you have $0 in your FI account, you will need $2 million of term life insurance. If you already have $500,000 in your FI account, then you will need $1.5 million of term life insurance to complete your FI if you were to die prematurely. I typically suggest term insurance because it's cheapest, and once you have your FI account fully funded, you won't need it for that purpose any longer. I would recommend a 30-year term if you are younger, even though it costs more because 10 years goes by so quickly, and when you renew at the end of 10 years because you are older, it'll cost more. Additionally, if your health changes and you become uninsurable after 10 years, you may be unable to qualify for a new policy or extend your coverage without paying significantly higher rates. Okay. However, suppose your budget is tight and you have a fixed amount to spend on life insurance. In that case, it is better to go with 10 years and get the full coverage than with 30 years and only receive partial coverage. Once you have more funds available, you can consider extending the term. Remember, the point of life insurance is to complete the family's FI if you die too soon, right? For this particular instance. I know there are many other purposes of life insurance, but for this particular book, that's what we needed to focus on. And remember, this was very general advice, and as you meet with, either as you do research or you meet with your financial advisor or insurance agent, you might have some different options presented that fit your situation better than this. And so there may be I guess what I'm saying is, like I said, this is really general advice, but your circumstances may call for something else. Okay. It's important to get policies on each spouse or one joint policy so that whichever spouse dies first, the other receives the payout. This immediate payout in life insurance proceeds should fully fund the family's minimum FI. That way, the surviving parent can focus on their children during this most difficult time and not worry about how they will pay the bills. Funding your FI with term life insurance as a preventative measure in case of a spouse's untimely death is highly recommended, especially for younger families. Having a policy in place has provided me and my wife with peace of mind throughout much of our married lives, knowing that our family would be financially taken care of if one of us were to pass away. The insurance cost is reasonable if you are younger and healthy. Meet with your life insurance agent to see which term insurance policy is best for your situation. Okay, peace of mind. Unforeseen, catastrophic financial events can happen to anyone. That is why these simple risk management techniques are so valuable. They provide peace of mind and confidence that if disaster strikes, you can continue working toward your FI. If you feel proficient in procuring these insurances, excellent, right? If you want to do your own research, if you want to be the one to do it, then that's fine. I encourage you to do so. However, if you need additional guidance, it's totally acceptable to contact a reputable insurance agent or financial professional for your health, disability, and life insurance coverage. Okay. Finally, I don't recommend commingling your checking account with your emergency fund because you might think you have more to spend for the month because of the excess cash in your account. Instead, open a separate savings account for your emergency fund. And remember, as you put these risk management techniques into practice, preparation is the best remedy for fear. All right, so that was a short chapter 5, but it very, very, very important. Okay, so remember, if any of that went over your head, return to this chapter and review these risk management techniques and make sure that you have them or have a plan to put them in place so that you are prepared for these unforeseen events in your life. So we're going to go ahead and just finish the chapter with next steps, and I need you to believe this. Preparation is a shield against uncertainty. Financial independence becomes more secure when I proactively protect what matters most. Examine, have I put safeguards in place to protect my family and financial future from unexpected events? Where are the gaps in my protection strategy? Act. Review your risk management strategies today. Start by building an emergency fund and ensuring that you have adequate health, disability, and life insurance to protect your financial independence. All right, so like I said, that wraps up Chapter 5. Thanks for being here with me today. I wish you the best and hope to see you in Chapter 6. So take care, and we'll talk to you soon.